Central bankers around the world are absolutely freaking out about a stock market crash, but will they pull the trigger on an emergency rate cut? With markets freaking out a little bit over the last 24 hours and volatility coming back in after the gap fill was made, we now have the golden pocket to make sure that day traders try to hold it up. But what does the data suggest actually occurs if we do get this emergency rate cut? And more importantly, have the Bank of Japan done enough to support the markets that were flash crashing as of Monday? One thing's for sure, volatility is here to stay, and we need to talk about it right now together. Stocks, commodities, and cryptos, let's get into it. Well, welcome back everybody to The Daily Show. My name's Tom, and today we're discussing everything about markets that we need to know right now, including the dark pool activity and of course what's going on in the options and the key levels on the charts. With big zones being hit over the last 24 hours, we'll discuss that soon. But let's get into what would happen if there was an emergency rate cut on the markets from the Federal Reserve. And we know this has happened a few times over the last decade, and in at least those periods, the markets reacted very poorly. Usually an emergency rate cut means there's something wrong. And we do need to be aware that if this does occur and it's not a September rate cut, there is something very sick usually going on underneath the hood. And it could bring us to this type of situation. You've probably seen this chart by now. We've shared it several times over on our X. Links in the description down below if you're interested in following along there. And of course, it's what everyone is worried about. A big market crash that ends up in a recession and even a possible depression, moving down as much as over 50%. Now, if you've been following the channel for a while, you would know that we do believe that one of these is coming over the next couple of years, but timing will be everything. And we have to look at the situation and the amount of information that we have that really presents for one of these big crashes right now. Is it really time for this to happen? Or when the Fed has pivoted in the past at many points, are we actually going to look at a semi-soft landing initially? Well, we'll look at the data around that in a moment, because the negative 8% we've seen on the market so far is actually in line with almost all of the normal pivots that we've seen over the last couple of decades. And actually the data suggests that there could be a little bit more positivity come rather than negativity, at least initially. Now, Bank of America have also put out some reports here. Mike Zaccardi over on X has shared this chart, and basically it shows here that financial conditions have not tightened materially according to them, nor has financial stress increased. This is very important because ultimately most of the problems in the world come from this one word, debt. And we know that there's a lot of debt out there, but we also know that right now people are not necessarily defaulting across the board. Yes, there are some problems depending on the stats that you've seen, but as we always say, make sure you've got the right data, because there's a lot of charts going out there that say that debt is exploding, and it's probably not true yet. We're looking for leverage and debt to be in markets. And in many ways, what happened this week to all of us was an example of over leverage being taken away. And we've got a chart on that coming up very, very soon. Now, I've put together a little bit of information about whether the odds are still in favor of the bulls. So here's why I think the bulls could still be in front. Never has the S&P 500 made 38 all-time highs in a year and not made at least one more. Now, of course, that's just one stat, but still very interesting. We also seen a Whaley breadth thrust and a triple 70 breadth thrust signal recently, which end up usually causing a weakness over a 2 to 3 week, even 1 month period after they trigger. But we usually have very good stats. In fact, the Whaley breadth thrust is close to 100% when it comes to overall bullish next 6 month periods. There's also only ever been one all-time high set in July over the last 40 plus years. So again, it's unlikely that the markets have found their top peak. And we've seen CTAs absolutely panic. Goldman Sachs fear market indicators go off the scale, and the VIX hit 65, which is usually symptomatic of a flash crash. And in all of those general contrarian setups over the last couple of years, and of course the big 65, which we'll see in a moment, again, markets do tend to be bullish over the next 3 month period. When the market is going up in 2 consecutive quarters, such as it's done this year as well, and there's a lot of stats around this, then as long as we've done over 10%, a strong positive correlation for another decent run upwards is there. And you've got to remember that central bankers around the world are completely gutless nowadays in our society. They will not force us into the hard yards. And the market has figured this out over the last couple of years, especially due to what happened during the pandemic in 2020, where we put a bazooka underneath the markets to make sure they were stabilized. Of course, too much money went into the system, causing inflation and all sorts of things, and it basically broke the system long term. So, of course, when things really blow up, it's going to be very brutal this time around. I think we're all aware of that if you're watching this channel. Eventually, things will end. It is the way of market booms and market busts. And we are due it when you think about the fact that we're getting on that 18 to 20 years since we saw the last big one, which was the global financial crisis. Here's a chart showing you from 1940 to 2024, when the S&P 500 is up 10%, over 10% in consecutive quarters, that it does have a pretty good forward overall ratio. And again, that is a good, strong statistic for us to look at when we think about how much the central banks have to do in terms of they can move from 5 and a bit percent from interest rates down a little bit and start to support this economy in still a positive jobs number. Now, that's almost unbelievable when you think about it. We've still got positive jobs numbers, yet everyone is calling for a rate cut because everything's exploding around us. The GDP is still growing. All of these things are still there. And really what we start to look for is whether we're getting a sign of the undercurrents in the markets being incredibly weak. And that's something that's very important. Do we have sectors that are sick? And at the moment, you could argue semiconductors are probably the sickest market. So, of course, that becomes the most watched one for us on this channel. Risk on, risk off ratio here from Grant Hawkridge does show that, of course, there's been a decent amount of risk off in recent times, and it's come down to a very important level where we've seen it before find bounces. Now, this is symptomatic of pretty much all the fear gauge markets that we've got right now, but let's have a look at the last couple of sessions. Now, of course, if we go to the S&P 500 large caps, if we look at the mid caps and the small caps, we'll notice that the last couple of days, 4 days ago even, things were looking okay across the hood, but things have started to slow down a little bit, and obviously there is some weakness there in the markets. We will be looking for these particular charts to show signs of improvement, with breadth improving as long as the markets continue to hold. So even if they're going sideways, it is possible that breadth could be improving. When it comes to the S&P 500 versus the VIX, whenever we see the VIX going massively up and then, of course, crossing back below the 30, that tends to be a pretty important point with markets finding lows. This one here from Seth Golden, you can see that this often is a turning point for bottoming style markets. And I want us to just focus on these bottoming style markets because they don't always bottom with just the flash crash itself, the 65 VIX. Sometimes it forces a secondary low to trap liquidity into further shorts. And actually, a lot of the time, what it will do is pull back to where it's come to over the last 24 hours, a 61.8 fib. So yes, we've seen the peak of volatility most likely with 65. We've dropped below, but in most of these cases, when you get these kind of flash crash style situations, they do tend to bounce fairly well. And that's what we call elastic demand. And we know here things like the 1 month call put skew here from macro charts, that fell through the floor. And again, in all of these situations, markets did recover. And that is a stat, all situations they recovered. Could this be the time that's different? Sure. But again, the stats and the odds are in that favor. Monday's VIX was touching something that we don't see very often. Again, the next 125 days, generally an overall forward positive correlation. You can also see here from Ned Davis Research that when we see a rate cut from the Fed, there are some interesting overall dynamics in the market, specifically from the Russell 2000. Now, the Russell 2000 went up a lot. Of course, FundStrat's Tom Lee, price action looking pretty good, big breakouts occurring. And then everyone was loving it. And of course, it's dropped like a rock. Now, funnily enough, that seems to be kind of what the Russell will do. Then we actually get the first rate cut. And in a lot of the soft landing or no landing scenarios, remember, that doesn't mean it doesn't crash. It just means that it doesn't crash for 12 months afterwards. The markets would actually recover at least over the next 4 months in the small cap. So this could be very interesting if you've been looking at the Russell. We'll look at the chart a little bit later on. The news about 10-year bond auctions, though. Treasuries fell over the last session, and the 10-year was pretty poor. Now, we'll update this in our next video to go through it in depth, but I just wanted to mention that the recent 10-year note draw was really bad, and we'll go through that in the next video. Let's have a look, though, of whether we get a rate cut, what it means. Why is this 8% that I keep talking about so important? The daily 200 simple moving average as well. Such an important indicator to have in your charts. Please put it on. Make sure you have a look at the S&P 500 over the last decade to 15 years, and you might notice some very interesting kind of like setups that happen around that point. Regardless of that, do we usually see a market that goes into a bit of a panic or a sell-off coming into a rate cut? Well, the answer is quite simply yes. It can be choppy, up, down, up, down, up, down, all around, very volatile. Does it usually drop straight after the rate cut across the board and then start to recover? Again, yes. It's usually around 2 months after the rate cut itself that we find out whether we're in a hard landing, something that's very terrible, or we go into the non-recessionary path. Remember, it doesn't mean there isn't a recession coming. It just means no recession over the next 12 months, and the markets can actually find quite a lot of recovery. Now, this is really together with an election year, so it's going to be very wild for us. And I encourage you, if it's your first time here on the channel, welcome, subscribe down below. Also, give it a thumbs up if you enjoy this content. We do put a lot of effort into bringing together like the good stuff rather than going through the crap. And there is a lot of crap out there when you look at all the data. Let's break down the S&P 500. Why do we think negative 8% such a key? Because when you look at 2 months out from a rate cut, this is something that has happened before. And you'll notice that in this case, anyway, it seems to chop because it goes up, down, up, down, up, down. -6 1 month later, -9. So again, stays around those lows for quite some time, and then goes absolutely ballistic over the next 12 months. Now, at the same time, this one, where we get a -7, actually finds a recovery, then goes negative, then goes absolutely ballistic over the next 12 months, which is actually symptomatic of the Whaley breadth thrust in many ways, usually a pretty strong market. Now, we're in earnings and everyone's forgotten about it because realistically the volatility is so extreme across the board. But just a reminder, we still have earnings. Of course, we still have these ones coming, DDOG, TTD, Gilead, a few others. And these will be still volatile events, although this week the options market's been pricing in some extreme volatility and things like Reddit and stuff were not moving to the degrees that they were. Now, I will leave these on the charts. These are the kind of points out here from the earnings nugget over on X. I like the little summary here for Robinhood and the earnings call. Again, a pretty good result. We have liked Robinhood on the channel. It got smashed this week, but it's finding a little bit of recovery after hours. So again, Robinhood doing quite well. Then there's Disney. Now, everyone's negative on Disney, although I do think, and we've looked at this on the chart before, we're looking for a turnaround in Disney. There will be one, I'm sure. It's oversold, is absolutely oversold, kind of like an Intel, and they do present themselves nice opportunities, but timing will be everything. So we'll bring that up on the channel when it's worth doing so. Now, we triggered a Whaley breadth thrust about 3 weeks ago. Usually we get this type of stat, weakness for the first 2, 3, 4 weeks, and then usually strength. Again, if this market's going to recover, we can follow that Whaley breadth thrust quite a lot. Gold Trust, getting some massive trades through it. We talked about the dark pool activity, but I thought this was the interesting one, a monster print coming in right at the gap fill here on the Ultra Pro TQQQ. We fill the gap and we sell off. And of course, that is expected. Someone bought down the low. We got that rally. It was beautiful. And at the same time, we knew that this gap fill was going to be a bit of a problem. So it's the first minor bear zone. And now we find ourselves back at around this area here, which just so happens to be a 61.8 fib. And it's very important that markets hold this level, because if they don't, it signals we're probably going to make a new low and we're going to put pressure on the daily 200 simple moving average. Let's move over now to the overall sector rotations that were occurring. Not much to really report here, except for home builders were down 2.88%. But when we put it in perspective over the last couple of weeks or the last 5 days, yes, it's been defensives at the top. So of course, it's still a defensive style market, and a lot of the other sectors are down. But I always look towards the financials a little bit. XLF still holding relatively well in the middle, and KRE is getting hit, but still holding up better considering how much it's moved over the last couple of weeks. Now let's move to the S&P 500. So we get the full gap fill, and we'll talk about that in a moment. But basically the market, the futures actually hit where they were and then sold off. And we can see here that our advanced decline line was kind of neutralized throughout the session, and that it doesn't really look super pretty from the bull side. In fact, the NASDAQ looks a little bit worse. But this is what happened. So we moved up in our private community. If you're ever interested in joining, free 7-day trial and links in the description down below. We talked about the 53.25 to 53.40 zone. Now, this is a very important level. You can see here I had it at the top, 53.43. I haven't changed anything, but the gap fill was right here. and we actually hit that fill and then started to find weakness. Now, it doesn't mean the market's absolutely going to crash or anything like that. It's perfectly normal for the markets to try to find liquidity and try to build a position. Now, what I was looking for today were dark pool activity trades that were here. And we did see a decent amount of trade going through. In fact, in Bookmap or some of the other ones, we did see quite a lot of defense happening around 5,200, which could be an important one because when we look at the indicators, that is going to be key. From a very small time frame trader, they're going to be a little bullish here with stops below this kind of area down here. And they're looking for, of course, new highs. Now, if we get a new high, we're more than likely going back to a very important zone, which is going to be 54.40. And this area is super key. It's going to be massive fib level. So many things to talk about if that does occur. But for now, we've got to focus on this symbol, the VAL, so the value area low of this range, and of course, the structure that's happening around the golden pocket. If we give that up, then there's a good chance we will make a new low, and you should be watching around the 5,000 at that point, which just so happens to be the daily 200 SMA. And this is such an important point. That area there is a massive bull magnet. And if you buy those areas that we'll talk about in future videos, generally speaking, the markets will come back. They'll test that point a few times and give you at least flexibility. Of course, got to make your own risks in this situation though. Let's have a look at the S&P 500, still negative gamma, still negative GEX. So basically this is a very negative market underneath the hood in the options. And you'll note here that there's still a chance of a waterfall at any time. So that's basically where the market gets squeezed to the downside. And 5,200 is the most important strike over the next two sessions. So you'll notice the expirations here. It has to hold above 5,200 to not create waterfall style kind of movements. And you'll notice even coming into the 16th now, volatility is here in August. Like there's no doubt that underneath the hood, there are problems. Let's move over to the CTAs. They went to capitulate. They bought up. They haven't exactly spiked it super hard like we've seen before, but that's still a good sign. The capitulation in itself shows us usually that we are forming a close to the base of a market. And I think that's a very, very important factor. We'll continue to bring the CTAs up. Brent still dropping off, although this is delayed, of course, by a day or two. We've got some good moves on oil, which we suspected over the last 24 hours. Gold, a little bit worrying that that's starting to drop off even more, so something that we need to watch. And of course, when it comes to the semiconductors, NVDA went underneath 100 by the close. Now, we know that this week it wants to hold above 100 because otherwise it's in that negative gamma situation. It keeps pushing down and creates a waterfall. We've got some bad news for NVIDIA because, of course, SMCI didn't do too well. We've got supply-demand issues. And on top of that, we've got some other issues as well that are starting to appear because we know when it comes to these markets, the biggest issue is going to be that if NVIDIA can't hold, then you have to start to say, well, is the AI bubble over? And that's going to take a lot of market kind of like, I guess, bullishness away. So that chart's very important. We need to be watching NVIDIA. Tesla, on the other hand, it's starting to struggle. 190 again being the big put level the market needs to hold. So effectively, these levels that we hit just over the close, they're all support levels. They're all where we need to find buyers. Now, I think Tesla could be suffering from not just TA. I think it could also be suffering from effectively, in some ways, getting into the political environment. I don't really like talking about this stuff on the channel, but I think there's some stats, 70 to 80% of voters, or people that buy Tesla are Democrats. And of course, with Elon getting involved in this situation a little bit, this is going to, I believe, potentially affect the amount of sales that are going on over the next coming quarters. And that could be something that needs to be considered on top of the TA. Ultimately, TA is the number one thing, and it's very important to look at. But I thought I'd mention it anyway because, you need to consider all situations, regardless of where you sit. You've got to think about this, and the data and the stats suggest that it is a possibility to weaken demand. Let's move over to the S&P 500 and central banks here, and you'll notice that we have a bit of a tick up in both of these particular central banks since the flash of Monday. And that shows you again, central bankers absolutely don't want this market to fall. The VIX, yes, it's spiked up, but ultimately it's probably not going to go back to 65. Expect it to stay between 20 and 35 for the next couple of, maybe next week or something like that. US dollar overall in terms of yields, we see yields basically holding. And this across with the bad bond auction, which we'll talk about in the next video, that led to treasuries falling from this resistance level. And as we've long said on this channel, if you're going to hold treasuries, you need to have a 12 to 18 month overall, or you've got to take it as soon as it hits these profit zones, because this is what happens. It's boring. It's like watching paint dry. I mean, I think it's going to get here, but it's going to take time. It's not going to be tomorrow. It's not going to be the next day. You need kind of a full out panic from the Fed and them to start really rate cutting aggressively, because of course the forward yield needs to drop off significantly to push those treasuries back up, along with risks coming back in that makes people demand treasuries and bonds. KRE, yep, it's fallen off, but again, finding support or at that level. ITB, another one. Our bond indicator still fluctuating up and down and all around. Not exactly freaking out, but certainly something that we're looking at, because of course we don't like to see the bonds market start to freak out at all. If that happens, you've got to pay attention. The US dollar, still looking for it to come back up a little bit more to the daily 20 up here. So looking for at least a 103.50 recovery there for the US dollar. Gold stuck in the middle of nowhere. So you can see here on the daily, gold is not that interesting. If anything, it's kind of just neutral in this zone. But silver actually showing a possibility of a trade. Now put in a super bull switch zone for silver. I think this is pretty positive. It's come back down, tested 26.50. It's an incredible level for silver position-based buyers and, of course, investors. And there could be a great day trade coming up there. So we'll look at that one. Speaking of decent, good day trades, of course, oil finding its foots again, or finding some kind of bid. So this is coming up a lot. 70, kind of 650 to 77 a barrel is its next problem. And yeah, found some nice buy pressure. And as a lot of you did mention in the comments, UK oil, Brent, was the one that actually triggered the best buy. In fact, I'll actually just show this to you so you can see it. So UK oil, what an incredible little chart here. Oh, that's a beautiful chart, guys. And that's actually triggering to an 80. So we'll see whether that one can hold through. Beautiful stuff there. Now, the Chinese market, Tencent coming back. Look at this. Big day for Tencent. If it can manage to get above that 377, this could mark the bottoming effect. Yes, the bottoming effect for the Chinese market. And you'll notice here, it has been horrible for the Chinese market. Of course, pulling back for quite some time. Now, we've talked about it a lot. Of course, I've liked it since over here in February. And it did amazingly well. Obviously, it had that short squeeze on it. But this is the nature, the sentiment to end a bear market, because there's a full bear market, does take time. We still need it to get above 17,400 to really be bullish, but you'll notice things like downward trends on smaller time frames are starting to get a bit pressured. And again, Tencent is the linchpin. It's starting to do well. Semiconductors, they fell off. They didn't actually fill the gap, by the way, due to some kind of poor earnings, I guess you would say, or poor future guidance. But NVDA is the one I'm watching. So you'll notice here, it filled that gap level we talked about up here. Then it's dumped down. It hit a 61.8 around 98. Now, I think this is a very good zone for bulls to come in. And in some ways, unfortunately, we ended up seeing this market kind of start to rally here in the futures at the time of this recording. But this 61.8 across the board is the area that we expect markets to find at least some bid. And you'll notice that's across many of them. Another one, crowd, absolutely getting trashed. Still holding up. Obviously, people are looking for this to do mean reversion to 280. Now, it doesn't mean it's a great investment, because it's probably going to have litigation all over it. But yeah, when markets go too far down, they often do bounce. And we reported on that the other day, and it's still doing okay. Tesla, as you can see, 61.8 fib getting pressured back onto this level. It may not be over for Tesla, but notice there's wick. And you're going to see this a lot. 204.28. Set an alert for that. If that happens and it gets above, could be a nice further rally for it. But I would keep in mind that I think the future earnings, there could be some problems there. I don't know. Do you agree? Let me know in the comments. US 2000, let's move over to that. Now, beautiful level. We know this is the key for the Russell 2K. It's the most traded zones, the 61.8 pocket. It started to look better, of course, sold off. It's come down, hit below these levels, needs to find bid here. If it doesn't, then we're moving to a new low, and then more than likely finding something like this. Now, that's not bad. That's actually an excellent setup, and I like those very much. But at the same time, some of you will not want to go under there. So it's a big level here. There's no doubt. US 30, look at this. Hideous rejections. Hideous. They look terrible. I mean, if you look at that, you would always say, wow, that market's going to sell off more. So if you look at the US 30 on merit, you look at the S&P, you look at the NASDAQ, they've all got this. They've all got these moves up to these gap fills and then big rejections from traders. And of course, with negative GEX, It is hard to be bullish as a day trader on these levels unless you've got tight stop losses and you know what you're doing. But that's nasty. So again, 39.5, you get above that, you close, it's going to be strong for the markets. Same thing here on the NASDAQ. Have we come back to the 61.8 fib? Yes. Did we fill the gap? Yes. Do we now have a super bullish level? Absolutely. So we have this rejection week. It looks terrible on the charts. Terrible, guys. But at the same time, 61.8 fibs, small structure, very small time frames, 10 minute, 5 minutes, those types of ones. And there's a little bid coming off here. So can the bid hold? If it does, then it can begin the discussion of getting a 61.8 pullback on the entire fall for the S&P 500. And then we move over to Bitcoin. It struggled a little bit and then it's found some buyers. And Ethereum and Bitcoin have got, in general, I would say, a little bit of buying pressure coming through. Again, it takes a while to stop a freight train. You get this initial crash. Often you'll get a dipping below. That happens quite a lot. Or you'll get what you've just seen. So this is a point. This is a point. Both are very interesting. Daily 200 on the S&P 500, guys. Get that on the charts. We'll go over it on the next video together. And do remember that the unemployment claims number is coming. The expectation of today's S&P 500 move is plus minus 1.2% based on the options market. If you're interested in finding out more about this stuff, then make sure to sign up down below to newsletter and everything else. And of course, we've got a sale on at the moment as well. If you're interested in finding out about replication, joining our community, any of those types of things. Check us out next. Thank you so much for watching. I appreciate your time, and I'd love to see you in the next video. Bye for now, guys.